Hi, I'm Craig, and I'm a coach at Dow Janes. And today we're going to be talking about how to invest in a bear market. And specifically, we're going to talk about three things. First, what is a bear market? Second, if I'm already invested, what should I do now that we're in a bear market? And third, if I'm not yet invested, but I have money that I'm ready to invest, what should I do now, given that we're in a bear market? So those are the three things we're going to cover in this video today. So first, what is a bear market? A bear market is a term for when the price of the market values have come down 20% or more from a previous high. And so this year, the value of the S&P 500 index and the NASDAQ index in January were at rather high, almost all-time highs, and since then have come down more than 20%. And so that's why we're starting to hear the term bear market, because officially entered into that territory where prices are down 20% from previous highs. Why is it called a bear? I think there are a few different rationales for that. Perhaps the market's going into hibernation for a little bit before it comes back out again and starts growing, or a bear's claws go down whereas a bull's horns go up, and that's why bears are used to describe down markets. Who can really say? The values have come down, and so obviously now you're seeing in the news what to do, and we're getting a lot of questions in our program, the $1 Million Year, about what should I do in this bear market. And so let's talk about that now. There are two things I really want to talk about. If I'm already invested, what should I do? And then if I'm not yet invested, but I have money ready to invest, what should I do with that? So first question, if you're already invested in the market, what to do? And the answer there is hold on tight. Obviously it's been a rocky year, but these are normal experience. It happens every so often. Business cycles, there's boom and then it kind of contraction, and then everything resets for the next growth cycle. So this is not abnormal. It's part of the investing experience. And the only thing you can really do to hamper yourself and your future results now is pull out of the market. So please don't do that. As long as you can keep a long time horizon with investing and stay invested for, at least the next 5 to 10 years, you'll totally be able to ride out whatever happens this year. And in 5 years, it'll be just a thing in the past. So it's important during down times like this to remember that when we're investing for the long term. Now's not a good time to pull your money out. It's not a good time to try to change your investments. All of that brings on a ton of risk. So instead, our recommendation is just to hang in there. Understand this is a totally normal part of the process with stocks. They go up, they go down. That whole up-down experience is part of what has the value go up over time. So as long as you're invested in the index, like we recommend, you can ride out this particular cycle, stay invested through this down period so that you're still invested when the up period starts and you're not missing out on anything. So the number one mistake everyday investors make in times like these is to pull money out of the market and tell themselves they're going to get back in, but it's quite hard to do. So it's much easier to manage if you just stay in and just ride it out, because again, there's nothing abnormal about this market experience. So that's what to do if you're already invested. But if you're not yet invested, or you have saved up some money to get invested, then what to do with that? And honestly, it kind of points to what to do all the time. It's like, keep saving money. Do the best you can to save even more money so that you have cash ready to invest whenever there are opportunities. Now you can think of this as an opportunity. The price has come down. And so if you do have money saved up to invest, and this is an important part, you're willing to invest that money for a long time, then, long time again being about 10 plus years, then now's a great time to invest. And, whether you invest now or next month, we get some questions about when's exactly the right time. It's impossible to know when exactly the right time is. You can only know it after the fact. So instead of doing that, prefer to think that, if we're not going to take the money out of our investment in 10 years from now, whether we get invested this month or next month or in December or a couple months from now, it's not so important, because it's all going to be somewhat similar on that longer term time frame, 10 years from now. So if you have money saved up and you're willing to invest it for a long time, now's a great time to invest. So check out our video on ETFs on the channel. channel to learn a bit more about how we might get started investing. And then one last tip, one practical way, if it feels too difficult to take all of the money you've saved to invest it at one time, just split it up into four and invest it at the beginning of the month for the next 4 months. That's called dollar cost averaging. And that way, if the market goes down between now and next month, you win a little bit because you can buy at a lower price. And if it goes up, well, you win because you invested some of your money now and it grew. So that's one practical way to get started and get over any emotional hump there may be to putting your money into the market. So that's basically it. Like I said, to recap, this is a normal occurrence in the market, if infrequent, but it does happen from time to time. So there's nothing abnormal about the market going down like this or having a correction or even a big correction like over 20% like we've had. It may seem risky to get involved in such a volatile market, but if we can extend the time frame that we're investing in, we can reduce the amount of risk that we're exposed to, because over longer periods of time, 10 years, we can feel more confident that the value of our investments will go up versus short periods of time. If you have money to invest but you need to spend it in a year, then right now is not a good time to invest. It's better to kind of sit on that money and be conservative about it because you said you're going to spend it in a year. But if you're ready to really invest, put your money away for 10 years or so, then now's a good time to invest. And if you want to dollar cost average your way into the market like I talked about, that's a totally reasonable thing to do, but it just matters to get started. And so that's why, we talk about taking that long-term perspective and perhaps averaging into the market over the month, because getting started is very powerful. And as long as we get started, then we give ourselves the opportunity to have our money grow over a long period of time. So thanks for checking out this video. Like I said, it's all part of the roller coaster ride. Is the ups and the downs are all part of the ride. So hang in there, focus on saving more money to get ready to invest, put that money into the market that you can afford to be without for a number of years so that it can grow, and keep doing what you're doing. And thanks for checking us out here on the Dow Janes channel. All right, bye.